All right, so you're trying to raise capital. Today in this video, I'm gonna show you the complete playbook, the frameworks, the email templates, as well as the pitch structure and the compliance requirements that separate successful raises from the 96% that fail. So you're gonna learn the 8-step pitch framework that actually gets investors to say yes and write checks, the email structure that generates 8% open rates when the industry average is only 1%, the 5 non-negotiables that determine whether a deal is worth pursuing, and the follow-up sequence that keeps investors engaged for future deals down the road. Plus, I'm gonna reveal the biggest mistake that founders or advisors make that get them into legal trouble with either FINRA or the SEC, and how to structure everything to stay compliant while maximizing your results or fees. Now, before we dive in, let me show you why this matters right now. My team at my investment banking firm, Cadenwood Group, have raised $14 billion in aggregate transaction volume. That includes $1 billion growth equity financing, hundreds of millions of dollars in both equity as well as debt raises, all deals ranging from 10 million early stage rounds all the way up to $1 billion capital formations for funds. Now, the success fees on these transactions range from $500,000 all the way up to $50 million for one of the deals that we have in our pipeline right now. But here's what makes this different. This isn't about who you know or where you went to school. This is a systematic approach that works whether you're raising equity for a SaaS company, a debt financing for a real estate development, or a growth financing for a manufacturing business. Regardless of whatever it may be, these principles stay the same. The execution stays the same, and the results, they stay the same as well. So let's start with the foundation, the 3 things that determine whether any raise will succeed or fail. The first is disqualification discipline. Most advisors take on any client who will be willing to pay them an upfront fee or retainer. That's exactly what you don't want to do. That's how you're going to waste 6 months on deals that never had a chance to begin with. You have to have strict criteria for what you're willing to bring on as a deal. Second is structuring the strategy for the raise correctly. Whether it be raising equity or debt, are you targeting venture capital firms, private equity firms, family offices? Each strategy requires completely different positioning, as well as your marketing and how you approach the overall transaction. Third is conviction transfer. If you don't believe in the deal with evidence to back it up, neither will the investors. Conviction isn't just enthusiasm, it's fact-based belief you can defend under scrutiny. So before you take on any client or pursue any raise, these 5 elements must exist. So here are the 5 non-negotiables. If you're missing even one of these, it means that success with your transaction will be almost impossible. So the company needs to have a clear product or service that exists today, not an idea or a concept, something that's real, that's tangible, that customers can buy or use right now. You also need to have a defined customer segment. Not everyone, not small businesses, but a specific group of people that you can identify as well as reach. There must be a defensible competitive advantage in addition to this. That means patents, exclusive partnerships, proprietary data, unique market insights, something that creates a real moat around the business. The next is tangible traction. This is an absolute must. Revenue, pilots, LOIs, notable investors that have already committed, or proof that the market wants this. Finally, a credible path to scale. For equity raises, that means at least $200 million in annual revenue potential. For funds, that's a 2.5x in distributions within 7 years. If you run these 5 tests on every single opportunity, most are gonna fail 3 or more. That is your signal to move on. So here's what trips almost everyone up who's coming from traditional sales. When you sell products, the buyer knows the problem immediately. They talk 80% of the time, you talk 20% of the time. You're discovering their needs and matching solutions. Capital raising is the opposite. Investors don't live in the problem. They aren't problem aware. They need education about the industry, the specific pain points the industry's in or the avatar's in, why current solutions fail, and why this particular approach will succeed. You're talking 80% of the time, which is flipped from traditional sales, carefully narrating a story that builds conviction. And this is why great salespeople often struggle with capital raising. They keep trying to discover needs that investors don't even know exist to begin with. You have to educate first and the sale becomes natural. So here's the 8-step pitch structure that we use internally as well as what we teach to our students. So this framework has closed billions of dollars in deals if you follow it exactly. So here's the first step. You have to establish founder competence. So this means previous exits, domain expertise, years in the industry. Investors bet on people first and opportunity second. So if you think of this from a traditional sales standpoint, you want to stack your status delta or the means of credibility, your track record. Why should they believe you and your capability of actually getting the job done first? And that creates the whole paradigm that they're going to view the rest of the information that you're going to present to them. So it's the same thing here. You need to stack that on first as the primary objective because now they're listening, all right? Their bullshit filter has been penetrated. Step 2 is creating a story on how the founder or founders discovered this problem and the solutions that currently exist. And then you position the solution, which is actually what the company is selling or the fund is doing, as the unique advantage or unique insight that they're providing to the marketplace. This builds credibility for everything that follows. And it's a logical story that you're creating in the investor or prospect's mind. Now, the third step is identify the specific problem with numbers attached. So who has this problem currently? How much does it cost them? And what happens if it's not solved? Step 4, in detail, you explain why the current solutions fail. Get specific about the shortcomings. This creates space for your solution. Step 5 is reveal the unique insight. What did everyone else miss? What changed to make this possible now? And this is how you position your contrarian truth. This is the light bulb moment that went off in your mind, explained in more detail because you give a high-level synopsis at the beginning, but also you create that light bulb moment in the person that you're speaking to, either in person or across the Zoom meeting. The 6th step is present the solution. Show exactly how it addresses each of the failures of the previous solutions or existing solutions that exist in the market. And you include proof that it works. And the 7th step is you calculate the market potential from the bottom up. You start with the price per customer multiplied by reachable customers in year 1. You build to total addressable market. You never use top-down projections. You do bottom-up projections. Step 8 is you explain the why now. What specifically changes with this capital? How will funds be deployed, and why is timing now critical for you to be deploying this capital into your development or marketing or sales efforts? So, the investor email that actually works. The subject line formula goes as follows: traction metric plus company description plus raise amount. That's what you use for your subject line. An example would be 3 million ARR SaaS platform, in brackets, you explain exactly what it does, raising 15 million Series A. The first line of the email is incredibly important because they're gonna see that in their inbox. It's the subject line, and then they're gonna see the first line of the email. So what you need to do is immediately signal credibility. You're gonna stack the status delta or the accolades of the founder in that first sentence of the email. So if you have a notable investor, you want to put that in that first email. If we're using that SaaS example and they're a part of YC, you want to have that in that first sentence. Whatever it may be, the anchor key highlight of the deal, you want to have it within that first sentence and stack it if possible. Second line is traction or proof. So growing by 20% month over month, 150% net dollar retention, 50 enterprise clients, whatever it may be, you want to talk about the traction. Here we are, this is what we're doing, and this is where we've gotten. Third line is the unique advantage. So exclusive partnerships, proprietary data sets, first mover position, whatever it may be. And then finally, you go into your call to action, which would be, would you like to review a deck, or would you have 15 minutes for a brief chat? No fluff, no hype, just facts. You don't want to speak in hyperbole. You don't want to use words like revolutionary, anything like that. It's cut and dry. You speak in fact, and you have no fluff, and you get direct to the point. That's how you get people to respond to you. This will generate about an 8% response rate. Now, if you go into very granular detail with how you create your investor list, that's obviously going to increase. But if you go to a database like Crunchbase or Apollo, which is very accessible for everyone, and you pull a relatively broad list, you're gonna see about an 8% response rate. So next is the follow-up sequence. Most people send worthless, just checking in emails. You don't wanna do that. Every follow-up needs to have new information. There needs to be context or a reason why you're reaching out. So whether it be new developments, new traction, a recent milestone hit, or a catalyst is about to be met, whatever it may be, you want to have a reason for reaching out. So day 0, you send the teaser, all right? 1 or 2 pages with company overview, business model, traction highlights, etc. Day 3, expanded proof points, additional metrics, recent wins, information that's not actually in the teaser. Day 7 is a milestone update. And you want to have all of these predetermined and loaded up into whatever sequencer you're using to send your emails. So those milestones might be a new customer closed, a partnership signed, product launch. All of this is going to create urgency, and it's going to keep you top of mind without saying, hey, just bumping this up, wanted to see if there's any interest here. You don't want to be doing that. So for every 5 to 7 days after, you have a purposeful update, and you only make sure that there's a reason for you actually getting in touch with them. Next thing that you could do is press coverage. New hires, technical breakthroughs, anything like that will always add value. So the most important part of this whole process is running the actual investor call. You can mess up the previous parts where you're sending the emails or the LinkedIn messages or whatever it may be, but the call is where you're actually going to get them. It's just like a sales call. You're not going to sell someone with your outreach methods or your ads or whatever it may be. It happens face to face. It's 2 people getting on a call over Zoom, on the phone, or in person. That's where the whole thing actually happens. So the pre-call preparation is critical. You research their last 10 investments, you identify patterns in their thesis, you do a brief deep dive on the founder, on their hot buttons, their likely objections, things that they like, they don't like, see articles, maybe look at their Twitter, their LinkedIn, look at their posts. Now, the call structure is very simple. 2 minutes, you do an introduction, you establish credibility on yourself, your firm. If you're the founder presenting, you just do a very high-level overview on yourself before going deeper into your credibility. The next 5 minutes is going to be discovery on the actual investor, on what they're looking for, on what they're doing, what their timelines look like. There's very key metrics that you're looking for here. What are they allocating towards in the next quarter? What does their buy box look like? Average ticket size? Do they do majority stakes? Do they want to take a board position? What does their timeline look like in terms of their internal process for diligence? These are all critical pieces of information that you need to have prior to you going into a presentation. And the next 10 minutes that follow thereafter are the founder or you as an advisor pitching the following 8-step structure. So 8 minutes, you open with the discussions, you address the common concerns. 5 minutes in, you close with specific next steps. So you take them through the 8 steps that we previously discussed, and then what you do is you address common concerns, you go through any questions, and then you go to next steps, which would normally be signing an NDA, going into the data room, setting up an additional call. Maybe there's other people from the investor side that are going to need to be involved in the process. Maybe you just spoke to an associate or an analyst and you need to have a more senior person come on the phone before you actually move to the next step and go into diligence. But the thing that you need to ensure that you get is, what does their investment process look like from here? What additional information might be helpful for them? And you want to keep track of this because your follow-up from here on out is always moving the next step forward. So if it's NDA, you make sure that the NDA gets signed. Make sure that data room access is given. And then from there, following up on specific documents that they're going through, anything that they may need to see that isn't in the data room, there's always going to be a next step. And your follow-up process is just making sure that that is being pushed forward. So now we move on to compliance requirements. This is where people can get into serious trouble. Now, it's important for me to disclose that if you're going to be approaching any of this material here today, as an advisor, you need to be a licensed FINRA member. You need to have the oversight of a broker-dealer. This means writing your SIE, your Series 63, at bare minimum, your Series 82, and you need to ensure that you have oversight from a broker-dealer when you are conducting any of this sort of work. Now, if you are looking to build your own capital advisory firm or your own boutique investment bank, and you're looking to get to 7 or 8 figures in a few years by providing advisory services, capital raising services, or even M&A advisory to companies, funds, etc., and use that as a vehicle to then move in to creating your own fund, whether it be private credit, private equity, doing a roll-up, creating a hedge fund, whatever it may be, whatever your principal end game is, which if you're on this channel, chances are you've been thinking that one of those is the path that you should go down, but you don't understand the deal-making principles that go in to creating a private equity fund that's going to actually produce results to bring on LP capital, not for a few million, but for hundreds of millions of dollars. Now, if that sounds at all interesting to you, I've created a video that breaks down the entire system and process that we used to create a boutique capital advisory firm within 90 days. This is the exact same system that I used to close a $128 million transaction within weeks of starting Cadenwood Group back in July of 2024. So I'm gonna leave that video in the description below. I'm also gonna leave it linked around this video. Watch that. As soon as you're done with this one, it's gonna take you through the entire process from front to back. So the next step is building conviction. Now, conviction isn't cheerleading, it's evidence-based belief. Test every single deal against this standard. Would you invest your own personal money into the deal? Document every proof point. Create an evidence library. For VCs, position as market dominant potential. For private equity, emphasize efficiency and EBITDA multiples. For family offices, focus on downside protection. Same company, but different framing based on the investor's priorities. The next is the investor outreach infrastructure. To reach investors at scale, you need proper infrastructure. Acquire 30 to 50 domain variations. These are your actual domains. You're going to set up 99 emails per domain for 3,000 to 5,000 total addresses. You're going to warm those domains up for 2 weeks before sending. And the reason why we do this is because we want to make sure that we can send thousands of emails a day without having any of those emails get burned, and we actually want them to land in the inbox. So if you think you can send thousands of emails from your own personal domain or personal email address, you're not going to be able to. You're going to burn the domain and the emails won't even be seen. So you want to monitor the deliverability using a tool like Instantly or SmartLead, which is the sequencer that you can send the emails from. And then what you're going to do for your list is you're going to pull 10 to 20,000 contacts from Crunchbase or Apollo or PitchBook, and these are going to be the investors. Now, the easiest thing to do is you can use voice to text on ChatGPT. You can tell it exactly what you're looking for, the deal type. You can even take the deck of the deal. You can put that in GPT and say, hey, I'm using this database. Find me investors that would be interested in this deal. Give me the exact parameters that I should be looking for. And then you take the response, you plug that into the database, and then you pull the search, and that's your list that you're then going to send the emails to, which I've already given you the framework on how to run those emails. Now, here's a key thing. If you are running this as an advisory firm, you never want to let the client or the founder, whoever you're conducting the advisory on behalf of, own the relationship with that investor. So if you don't have a pre-existing relationship with the person that you've sent the email to and you're getting on the phone, you want to make sure that you control the narrative and the engagement and interaction so you develop the relationship. It's your contact, all right? Those belong to your firm. So you want to tag every interaction. You want to maintain weekly pipeline reviews within your internal CRM, and you want to use standardized templates for all of this. Next is managing multiple deals. So you want to document progression strategy. You start with a teaser to create interest. You move to the deck or full story. You open the data room only after real interest has been secured. And each stage will require more commitment from the investors. And you want to track all of this in the pipeline that you have in your CRM. You can use AI tools to research mandates and prepare for diligence. This means prior to you getting on the phone, we already discussed this, but you can use AI to identify what their actual mandate is before you get on the phone. You can use automated follow-ups while maintaining personalization using AI. And you can build modular templates for different kinds of scenarios, different kinds of investor archetypes, whatever it may be. So that was the exact process that we use internally at Cadenwood Group and Capital, in addition to the process that we teach our students to close transactions on behalf of clients. Now, if you're interested in learning more about this process, because this really was just the tip of the iceberg in terms of all of the intricate detail that goes into completing these kinds of transactions. Again, like I said, I made a video that breaks it down into more detail that you can click on beneath this one or around the video here, and you're gonna be able to see not only how to raise capital, but also build a boutique capital advisory firm or investment bank that is capable of generating 7 to 8 figures a year in revenue within 2 years, and then use that as the foundation to then go and flip to the buy side where you are the principal investor, whether that's private equity, roll-ups, private credit, etc. Now, all of those business models assume that you already understand the principles of deal making, what makes institutional capital move, how to negotiate deals, having an investor Rolodex, having a track record and a team behind you. And that's the reason why we go into advisory first before going into the principal model. So go down beneath this video, watch the next one, and I'll see you on the other side.